In this video, I'm going to be talking about the collapse of the First Republic Bank, as well as rate hikes, inflation, and even potentially the US completely running out of money. So jumping right into it, we can see here that First Republic got rescued. Economists predict further pain with a new era of higher inflation. So I just wanted to go over this article and speak to you guys a little bit about what this means in general and then what this could mean for you. So after the rescue of FRC, or First Republic Bank, by JPMorgan Chase over the weekend, leading economists predicted a prolonged period of higher interest rates that will expose further frailties in the banking sector, potentially compromising the capacity of central banks to rein in inflation. So basically what they're saying here is that we're probably going to be in a time period where we're still in high inflation for longer than we really thought. The US Fed Reserve has announced its latest monetary policy decision on Wednesday, which is today. So that's coming out at 2 p.m., which is going to be after this video is released. So let's see what that is, but most likely people are expecting that 25 BPS hike. So economists warned in recent days that price pressures look likely to remain higher for longer. And why is that? It's because 80% of chief economists surveyed that central banks face a trade-off between managing inflation and maintaining financial sector stability, which we're going to go further into detail here when we talk about the debt ceiling. But, more notably, the chief economists are expecting that central banks will have to play a very delicate dance between wanting to bring down inflation further and the financial stability concerns that have also arisen in the last few months. FRC became the latest casualty over the weekend, but definitely not the first. It was the third among mid-sized US banks after a sudden collapse of Silicon Valley Bank and Signature Bank in early March. So I'm sure you guys heard about those banks collapsing, and them getting bailed out, and guess what happened this time? FRC got bailed out as well. So this time it was JPMorgan Chase that rode to the rescue. People haven't pivoted in this new era, that we have an era that will be structurally more inflationary, a world of post-globalization where we don't have the same scale of trade, and there's going to be more trade barriers, among many other things. So people are still not realizing that we're really moving into this new era where you can't just do the same things and expect the same results. We have a declining workforce, which requires investment and automation in many markets, so less generation of capital, less free movement of capital and goods, and more demands for capital. That means inflation. The impulse of inflation will be higher. This is something that I tend to agree with. I think inflation is going to be here to stick around for a little bit longer than people actually realize. He also drew attention to the IMF, International Monetary Fund, latest financial stability reports reference to interconnectedness of leverage, liquidity, and these pockets of instability. So what does that mean? That doesn't mean that we're not going to have instability, but it means that it's going to be worse down the road if inflation doesn't come down to levels of 2 to 3% and central banks are still there. So I think we're still very, very far away from levels of 2 to 3% inflation. So we're still in for a ton of instability. And I think the best thing to do right now is to be cautious with your investments. Invest in very safe long-term assets that you believe are going to do well. It's extremely difficult to try to trade in markets like this. So that's kind of what I recommend, is keeping a lot of cash on hand, dollar cost averaging into good assets that you think are going to survive 5-10 years down the road. That way you won't have to be worrying about managing your portfolio on a day-to-day basis, because most people are working full-time. They don't really have time to just sit there in front of the screen, maybe like I do, and make these trades. So I also want to talk about the debt ceiling. This is also absurd, and this just came out yesterday, saying that Janet Yellen warns US could run out of cash by June 1st. So what does that mean? Reaching the debt ceiling would mean that the government is unable to borrow any more money. So on Monday, Yellen urged Congress to act as soon as possible to address the limit, essentially, which is $31.4 trillion. So we're going to reach that limit, and it's been raised, extended, or revised 78 times since 1960, which is insane. I mean, the spending is just out of control. President Joe Biden has called a meeting of congressional leaders on the issue on May 9th. So clearly something needs to be done, and let me tell you why something needs to be done. As crazy as it sounds that we're going to run out of cash and that we're just going to need to keep basically printing out money and loaning money, why do we have to do that? It's because a default, which would be the first in U.S. history, could upend global financial markets and shatter trust in the U.S. as a global business partner. Experts have warned that a default could also see the U.S. head into a recession and lead to rising unemployment. It would mean that the U.S. would be unable to borrow money to pay salaries of the government employees and military personnel, Social Security checks, or for other obligations such as defense contractor payments. So even weather forecasts could ultimately be impacted, as many rely on data from federally funded national weather services. So basically, anything that is related to government personnel, like employees, even social security checks, which are also going to be running out, by the way, which is a whole nother video. But this is huge because if we default for the first time, that would one give it lose. We've already lost lots of trust as a global business partner, but that would just tank us even more. On top of that, we could go into an actual recession and have higher unemployment because all these government employees are not going to be getting paid, which there's tons of government employees and military personnel, of course. And then, even people like weather forecasts could be, implicated, and defense contractor payments could even be affected. So this is just huge. And I really hope that on the 9th they can figure this out. What I think is going to happen is what always happens. What has happened for the past 78 times. They're just going to raise the debt ceiling, which isn't a permanent solution, of course, but at least it will, cause turmoil to not occur right now. And that's kind of like this, what we talked about earlier, is that dilemma that they face between, keeping inflation down and then keeping the financial sector afloat. It's a really big dilemma that they've been facing for some time now. And I hope they can sort this out in the years to come, but definitely be ready for sky high inflation and even more rate hikes. If you guys enjoyed this video, I'd really appreciate it if you could drop a like, comment, and subscribe. I'll see you guys in the next one. Thanks.